Hello, everyone. Just going to take a look at some things in the healthcare sector here, real quick. And I like to say that pretty much any chart can teach you a lesson about the market. Most people tend to overthink the market. There are literally NASA scientists using AI to try to over or outperform the market, and most of them haven't done a very good job. So at stockmarketjobber.com, I just want to emphasize that we just focus on certain principles, and one of them is price levels, and one of them is momentum. So let's just take a look at a couple things here in the healthcare sector, and you'll probably be able to see what I'm talking about. At least that's the idea, but I'm confident that you will. There's Buddy. He's our bull. Notice he's our mascot. All right, so first thing we want to do First thing we want to do is just look here at our healthcare sector. Okay, there's 11 sectors in the S&P 500, and healthcare is one of them, and it's the second largest after technology. And I want to show you this important principle of how something that was resistance can turn into support. Resistance is a large group of sellers trying to sell their shares at or close to the same price. In this case, it's 134. And we can see when the market's moving higher, the buyers can't find enough shares to fulfill all of their demand or to finish their order, so they have to pay higher prices. When we get to a resistance level, the tide turns. All of a sudden, there is enough supply or sell orders that the buyers can buy all they want to, and this makes the market stop going higher. Now, sometimes we have markets that are levels that can retain their importance for a long time. We call that market memory. So we can see here we ran into resistance in May and then again in August at pretty much precisely the same level. So this is what we call market memory. And you can also see it down here on the support. If we found a bottom around 120 here, and then a few months later, it was bottom around 120 again. So market memory, sometimes these levels can stay intact for a long time. There's also this concept, or fundamental, I should say, of conversion. Levels that were resistance can convert into support. It seems pretty mysterious, but it's true, and you can see it right here on this chart. Resistance here became support over here. Now, the traditional reason for this is seller's remorse. There are people who sold who thought they did a good job when the shares went lower, but after they go higher, a lot of the people that sold experience seller's remorse. So they tell themselves, I shouldn't have sold. I want to buy my shares back. But here's the thing. I don't want to pay more than I sold them for. So they place their buy orders at the same level they sold at. So if there's enough remorseful sellers placing buy orders, the level that was resistance can turn into support, and that's what happened here. So maybe it's a good time to consider buying some healthcare stocks as long as the spider that follows the sector stays above this level. We're looking at ETFs that are called spiders that track these sectors. So this is healthcare, but I just want to illustrate resistance can turn into support. We can see that on a lot of charts. Here I want to show you a principle that we focus on, and that's momentum. Momentum is a measurement of how far a stock has moved in a given period of time. And most stocks spend most of their time trading within their traditional or usual or typical trading ranges. If they get above that, we call it overbought. If they get below it, we call it oversold. And this is important because this will draw investors into the market. If it's overbought, they're going to be traders that are anticipating a sell-off or a reversion to the mean. And if they're oversold, we're going to get traders that come into the market as buyers because they're going to be expecting a reversion to the mean. Now, these red lines here are what we call Bollinger Bands. It's a very common and very effective indicator to indicate whether something is overbought or oversold. This top red line is 2 standard deviations above the 20-day moving average, and this red line is 2 standard deviations below the 20-day moving average. Now look what happens when we exceed this threshold. we tend to reverse. All right. We get to the threshold, we tend to reverse. 95% of all trading should occur within 2 standard deviations of the mean. So that's why we get these reversions like we had down here. A lot of the algorithmic trading that goes on these days is based on statistics. So that's why this indicator is effective. So if we get below the threshold on the bottom, there's a chance that that's going to draw buyers into the market and they're going to push it higher. And if we get above the threshold on the top, there's a good chance that's going to bring sellers into the market and they're going to push it lower. And we can see that's the case here. So the Bollinger Band uses 20 days as its, or I should say 20 time periods as its default setting. In this situation, we're looking at a daily chart where each one of these candlesticks is a day. So it's measuring 20 days. If you were a day trader and you put this on just a daily chart, it would be measuring 20 minutes. So this 2 standard deviations would be above and below the 20-minute moving average. All these indicators come with defaults, and you can change the defaults depending on the particular security. Why is it 20 in this case? I don't know. My guess is that John Bollinger, who has taken credit for inventing these, that's just what he liked to use, but as a starting point. But different stocks have different personalities, so don't be afraid to change the settings on your default or on your indicators to see if you can find something that's more effective on whatever it is that you're looking at. And then before I wrap it up, I just want to show you this biotech sector here, XBI, Spider Biotech. Once again, we see, oops, let me get my pen working here. Notice how this resistance was same level as here, resistance here, 95.50. Why is this important? Well, let's just walk through a theoretical trade. So let's just say we're back here and you see this share is going down and you say to yourself, wait a second, this level was a support level. I know there's a market memory, so maybe I'll consider buying when we get to this support. You buy and it starts going higher. Now you ask yourself, where should I sell? You realize that, or you know that, at least you know now, that a lot of times markets run into resistance at former resistance levels. So this is a good place to consider having a price target. In this case, you would have had it around 95 and you would have bought down here around 61 or 62 and you would have sold up here around 95. Not using any kind of secret mythical formula or anything like that. Just having a knowledge of where the important levels are is enough to profit. And that was the case here. Well, that would have been the case with this theoretical trade. All right, everybody. So thanks a lot. That's all I wanted to talk to you about today. And I will see you soon. And thank you for coming to stockmarketjobber.com.